In this presentation, we will record an adjusting entry related to unearned revenue within QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the Open Windows open. In order to open the Open Windows, you go to the View dropdown and select the Open Windows list. We're going to take a look at the financial statements first here. We're going to select the Reports dropdown. We're going to go to the Company and Financials and then take a look at the Balance Sheet Standard. Within the balance sheet, we'll change the dates up top in the Customize Report field. We will change them from 01/01/20 to 02/29/20. That's going to be January through February, February being our cutoff date. Then we're going to say OK. Now this adjusting entry will be different than you might see in normal financial accounting processes when you just put in debits and credits. The reason for this will be this. Normally when you have the financial accounting and you think of a deposit or some advanced type of payment, we're going to say that we got paid before we actually did the work, which is a little backwards. If I go back to the Home tab, you'll recall when we entered this process, we had an advanced deposit. So in other words, normally we have the invoice happening and then we receive payment for that invoice, or the two things happen at the same time. Whereas we could think of like someone buying something in the store where we have the sales receipt, the money, and the transaction, the work had been done at the same point in time. In this case, then, we're saying that the money was received before we did the invoice. Now, if we were just to enter journal entries and we weren't thinking about any type of subledger, then what we would do is we would say, all right, what I should do there is I would record the money that we got. We would debit the cash in normal financial accounting, and then we would credit a liability because we can't credit revenue because we have not yet earned it. Therefore, we would credit unearned revenue, which would be a liability type of account. So typically in financial accounting, you would then say there was an unearned revenue account in a liability type of account down here, other current liability. Now some of that unearned revenue has been earned. Therefore, we need to take it out of unearned revenue and record it as revenue because now it had been earned at this point in time. That's the standard format you'll see in financial accounting. It'll be a little bit different here, however, because our problem here is that when we entered this in the system, we're not only thinking about the fact that we got paid before we did the work, and therefore we need to be recording a liability or something other than a revenue account, but we also want to be able to tie out the cash that we received to the invoice that we're going to make in the future. In other words, we received the payment here, which usually would be this one. Later, we're going to create an invoice related to that cash that we had then received. And we want to be able to match those two things out. We do that in the subledger account, which tracks the information by customer. Now, if we put it into accounts receivable, we don't have that kind of link, and therefore that's a problem for us. So many people in practice then, logistically, it would make sense for us then to say, well, why don't we put that into the accounts receivable account? So if we put that into the accounts receivable and have a negative receivable, then we'll be able to say and link up the future invoice related to it in the sub account and track the customer balances in one area. So that's basically what we end up doing. You'll often see this. It'll confuse a lot of people when the first time they see this, but it's something that you will probably run across if you enter an industry that has this type of situation. So therefore, here we have a positive receivable number, but if we go to the detail report, go to the reports dropdown, and we go to the customers and receivables, and we look at the customer balance detail, and we scan through this, what we're looking for is any kind of negative balance here that should really be a liability. So for example, you'll note up top, we did this process here where we had this 250. This was a deposit, a payment that we made before we issued the invoice, and then we issued the invoice, and then the rest of it was paid. At this point in time, you'll note we had a negative balance right there, which isn't exactly proper because it should be a positive liability, not a negative receivable for this customer. However, then we completed the transaction within this time period. It went back down to zero and everything's okay as of our cutoff date, which is the 29th, no problem. However, if we scroll down to some of these others, we're looking for a negative type of balance to see if we have any. This last one here, string music, we have a payment that happened before we did the work. So that could be something, types of industries would have this. If we sell something like subscriptions, then we get paid before we do the work. Or if we have rental stuff, then we might rent something out and ask for a deposit of some type. And then we have a similar kind of situation where we got money that we didn't earn yet. There's no revenue related to it. Or in our case, we are going to be giving guitars. Someone ordered a guitar that we didn't have in the store. We said we're going to order it for them, but we would like a down payment for it. So we want this money first. Now, once we issue the invoice, this will clear out. It won't be a problem. But right now, to be on a perfect accrual basis, we should not be having a negative receivable here, but rather a positive liability. So we're going to keep this here and do this process for the points of logistically being able to track the payments and invoice, even though they're happening in reverse order with the customer balance detailed report. However, we're going to make an adjusting entry periodically at the end of the month or year so that we can present our financial statements on an accrual basis. It's just like any other adjusting entry. We're going to say, hey, look, logistically, this makes sense logistically for us to do, and therefore we will do it. And then we'll make the adjustment just as we would with any other adjustment, because any other adjustment, we're admitting the same thing. We're saying, hey, I'm not going to be on a perfect accrual basis every day throughout the month. I'm going to do what's logistically sound. And then at the end of the month, we will make the adjustment because that's more efficient to do. So again, not the same thing you'll see in normal, debit and credit kind of when you learn financial accounting, because we're not considering so much the link with the subledger and how that would happen within the software, or at least within this software. And something that you will typically come across in practice. So be aware of that. All right, so we're going to do this then. So what are we going to do? We're going to be debiting or increasing the accounts receivable by this 300, making the total of the 10,974 go up. The other side then going to the unearned revenue, which is going to be basically a liability type of account. So both of those accounts are going to be balance sheet accounts. So you would think we could use either one of them. However, when you use the accounts receivable account, because it's a special account that's tracking the customers, it's a little bit difficult to use the register for it. Therefore, we're actually going to be using the unearned revenue account, which we haven't set up yet. Therefore, we're going to set up an unearned revenue account, then use the register for it. So again, the normal way we would do this is go to the company, and then we would go to the make journal entries, and then we would make a journal entry. But there's only 2 accounts involved, so we can use the registers without much difficulty. It'll still make a journal entry for us. Closing this back out, we're going to go to the lists drop down. We're going to use the chart of accounts. Then we're going to create another account because we don't have any unearned revenue, which would be down here in the liabilities. Therefore, we're going to select the accounts drop down, which is really an account rise up. And we're going to go up to the new item up top. Then we're going to be creating an other current liability type of account, other current liability. And we will then say continue. That other current liability will be named and called the unearned revenue. Now, you might see, depending on the type of industry, that someone might call it a deposit or an advanced payment, advanced customer payment, something like that. They're all, in essence, the same concept. We got money before we did the work. We haven't earned the work. We haven't earned the money. We got money from customers that we haven't earned. It's not ours. Therefore, it's a liability. So we're going to say save and close. So now here we have it. We're going to double click on that register then. Now we're in the register. And we're going to say this is as of the cutoff date, 2/29. We're then going to say that this account is going to be going up. Therefore, we're going to be increasing it by the 300. And the other side is going to be going to the accounts receivable. And then the memo, let's just put adjusting entry. And note that I can't record something to accounts receivable without a customer. And you might say, well, I don't have a customer field here. What are we going to do? Well, we could use the splits icon down here. That's usually when there's more than one account involved. But here, we're just going to use it to add the customer. So we're going to say split. And now we have more fields that we can then use. And we're going to say, and we can actually put a adjusting entry here. And the customer, I believe, was string music. So I'm going to type in string music. There we have it. So that is it. So then we're going to say save and close or record. And let's see if it does what we expect it to do. What do we expect it to do? Decrease the receivable and record the other side into the unearned revenue. So then we're going to go back to well, let's close this out. We don't need this. We're going to close this out. We're going to close this out and we'll go to the balance sheet. So let's take a look at the balance sheet. Within the balance sheet in the receivables, we're going to double click on the receivables, scroll down to the bottom, and we see that we have the 300 being added to it here. It is an adjusting entry given by the journal entry and the adjusting entry here. If we double click on that 300, then we see our journal entry. If we double click the journal entry, we get to the actual debits and credits. Closing this back out, closing this back out, and then closing this back out, we then see the detail for it in the customer balance detail in the open windows to the left. Scrolling back down, we see the 300, and we see the 300 of the journal entry, making it go back down to 0. So we're saying, hey, it's not going to be in the receivables here. It's going to be a liability instead. It's not a negative receivable. It's a liability. We see the 11,274 here. If I close this back out, 11,274 in the accounts receivable. Let's take a look at the other side, which is going to be an unearned revenue, which we just set up down here as a liability type of account. That's going to be this 300 here. If we double click on that 300, we're going to get to our adjusting entry. Double clicking on that, we get to our journal entry. Double clicking the journal entry, we get to our debits and credits. Closing this back out, closing this back out, closing this back out. You'll see it's basically the same bottom line number or concept, but instead of having a negative asset up here decreasing the receivable, we have a positive liability down here. Again, why don't we do that from the start? Because I can't tie out, if I've made this as a journal entry and just put the 300 there, I can't tie it out to the customer invoice that we're going to be sending out in the future, and I would have to do something a little bit more complicated than just simply making an invoice, and therefore logistically it makes sense. Now, what are we going to do about this later? We're going to have to reverse this entry, of course, because we don't want it on the books. We're going to say, hey, and you want to think about the adjusting entry process different. Like think about a whole different department doing the adjusting entries than entering the journal entries. It might be the same person, but think about them as different. And if they are then, which they often are in a larger organization, then you're going to say, well, I don't want to mess up, if I'm the adjusting department, I don't want to mess up the normal journal entry process. What they're doing up here works logistically. I want to keep that. I'm not fixing an error here. What I'm doing is making the financial statements proper as of the cutoff date to display them. What they're doing is working. That's why we have the system set up in that format. So what I want to do is basically do this reversing entry, make things correct as of the cutoff date, 2/29, then reverse it as of the first day of the next time period, and that will allow then them to push forward without this funny entry and they're messing them up. So we're going to have to reverse this entry to get back to the normal spot as of the first day of the next month. Let's take a look at the trial balance and see where we are at this point, and then we'll keep pushing forward. We're going to scroll down to the accounting and taxes, take a look at the trial balance. We're going to change the dates up top from 01/01/20 to 02/29/20. Here it is, and you can then review these numbers. If they look good, that's great. If not, then think about changing the dates. See if it's a date issue that is the problem. Use the auto zoom to fix it. It's great practice to fix it. If you don't want to fix it or you want to move forward and have the same numbers, we're going to have backup files, not for every section, but for most of the sections that you should be able to use to get to that relevant point, and then have the same numbers as you move forward from there.